Hello everybody, welcome back. It's another week, another tax topic. Today we are talking about inherited assets. In this we're talking only about the impacts to you in receiving inherited assets. We are not talking about estate planning or gifting or filing for estate tax. And as usual, this is not meant to be specific tax advice. It's an overview and we're certainly not giving legal advice. So in general, when someone dies, the value of their assets, the value of everything that they owned, is added up and included in their estate for tax purposes. So when that's passed through to you, as that value has already been included in their estate, you receive it tax-free at that higher value, what it was worth when the person passed away. So the easiest ones to talk about are personal items, vehicles, bank account balances. Those things come to you tax-free. There's no tax impact to receiving cash from the bank account or their vehicle or the special china that you received from their home. Those things don't have a tax impact to you, the beneficiary. Life insurance proceeds also are tax-free. The only thing you might pay tax on with life insurance is interest. So in the time that it takes between when the person passes away and the time that you receive the benefits, there are often interest attributed to that, and you'll get a 1099 for the interest and pay tax on that, but not on the benefit itself. A bit more complex, things like stock, brokerage accounts, and real estate. For real estate, consider getting an appraisal. If you are inheriting a piece of real estate, when you go to sell these things, your cost in these assets is going to be what it was worth the date that person passed away. So with stock, it's pretty easy to find that out, and brokerage firms are usually pretty good at establishing that value for you and tracking that for you in your account. But for real estate, consider getting an appraisal unless you're going to turn around and sell the property fairly quickly. Retirement accounts, traditional tax-deferred retirement money that would have been taxable to the person who passed away is also taxable to you. It's really important, if you have these retirement accounts, please check and make sure that your beneficiaries are designated and that they are up to date. Know that if you don't have a beneficiary on your retirement account and that retirement account distributes to your estate only has a $600 exemption, and then it's going to pay tax on all of the rest of that at really high rates. So estates pay up to 37% in income tax on income over about $13,000. It doesn't take much for a retirement account to be above that, and to have that 37% haircut is huge. So please make sure that you have beneficiaries designated. As we are talking about you as the beneficiary, just know that if you are inheriting traditional money, a traditional IRA, a 401k, that those funds are going to be taxable to you just as they would have been to the account owner. And know that there are rules about how long you have to pull that money out. So generally, the general rule is over 10 years, could be 5 years, but definitely we'll get into that in another video. It's complicated. So annuities I put them as the most complicated because it depends. Some annuities are funded pre-tax, like that traditional IRA, traditional 401k, and so those funds are all going to be taxable when they come out. Some are funded with after-tax funds, so you'll pay tax on the earnings in that account, so on the interest. So let's just talk through an example, pretty common example. You have a relative that passed away, they had a house, and they've got 4 beneficiaries, including you. The executor, the person in charge of administering the estate, is going to sell the house and then distribute the funds. So you're not going to actually receive the house itself, you're going to receive the funds. She also named you as a beneficiary on a life insurance policy. So life insurance first, as we talked about, that one is the easiest because it just comes through to you tax-free. You may pay some tax on the interest, but the principal is not taxable. For the estate, administering the house, it's going to sell the house, in this case, fairly quickly after the person passed away. So there won't be any gain on the house. The cost of the house for this purpose is what it was worth when the person passed away, not what they paid for it 30 years ago. So nobody paid tax on that profit over the 30 years. The estate's going to sell the house. It's going to have generally no profit in a pretty short period of time, and it's going to distribute the cash to you. Again, you're not going to pay tax on the cash. You'll pay tax on interest. If it sits in the estate account for a little while before it comes through to you, you may pay tax on the interest. But otherwise, tax-free. So takeaways, please be sure to designate beneficiaries on retirement accounts. Let me know if there are any questions. Is there anything that I missed? Anything we should talk about next week? Definitely let me know, and have a wonderful week.